Welcome to Yellow Tunnel. My name is Vlad Karpel. I'm CEO and founder of Yellow Tunnel and TradeSpoon. And today I would like to discuss game theory, why it's important for traders, and how to apply game theory into current market conditions. For those of you who are new, welcome. This is my brief bio. I was Executive Vice President and Head of Technology at Options Express from its inception through 2007. Since I left Options Express, I work as a consultant and investor in several financial technology firms here in Chicago. Since I left Options Express, started TradeSpoon in 2012. Yellow Tunnel has been almost a year. I've been trading and managing my own money for over 15 years, mentoring and teaching TradeSpoon subscribers how to trade stock and options. And finally, I have a master's degree in computer science, specializing in technology and science. Since I'm going to go through some trading examples, very important to look at the disclosures. I'm going to leave this for a second so you guys can take a look. So let's talk about game theory. What does it mean and why is it important for TradeSpoon and Yellow Tunnel subscribers and for traders in general? So according to Investopedia, game theory is a theoretical framework for conceiving social situation among competing players. In some respect, game theory is the science of strategy, or at least the optimal decision-making of independent and competing actors in strategic setting. The key pioneers of game theory were mathematicians John von Neumann and John Nash, as well as economist Oscar Morgenstern. So I'm trying to draw a parallel or application for game theory in terms of trading. So in trading, I found this an example where you could be a bull or you can be a bear, right? And as a bear, you can win and lose, and as a bull, you can win and lose. And from my experience, if you're always a bull, if always bull's winning and you trade as a bull, or you're always a bear and you're always winning as the bear, I think your percentage of winning trades will be less. You can see this outcome, 0-0. If you're always bear and you always have, you're always short, you're always losing money, or you're always a bull, you're always losing money, also this is not an optimal strategy. What I found for myself, that often it's very important to be both bull and bear. So you have bullish traders that are always bulls will win, bearish trades that are always bearish will win, but the optimal situation is where you can assume both we're ahead of a bull and a bear. So there are market neutral strategies that we can talk about shortly, butterfly, condors, but you also can be long and short market right now by doing spreads. So multi-legged strategy where you can express your bias, you can be a bull or you can be bear, but you're a bull, you can be long and short market at the same time, would be an optimal combination for you to be more successful as a trader. So what does it mean? One important is to have a trading plan, right? We always talked about it, that trading becomes, in simplistic terms, there's two important components. Is what your percentage of winning trades, right? Just like in poker, you will know each hand will give you certain combination. Each combination gives you a certain probability of winning. And then you have risk versus reward. How much money is in the pot, and how much are you betting versus, so what's your risk versus reward ratio, and what is your percentage of winning trades? In trading, it's the same thing. You look at your trades and you structure them with certain probability of success. It could be 90% probability, 80% probability, and then you have risk versus reward. For every dollar that you invest, do you make 50 cents? Do you make $1.50? And the idea is that over a long period of time, if you do this over and over 10,000 times, will it yield positive results? So in TradeSpoon, I showed the live trading room. We've been trading for the past 3 years in the live trading room environment, and the winning rate is 75%. So I know long-term, when I use TradeSpoon statistics and models, 75% of the time, the trade goes in my direction. So the second part of my job is to make sure that the 3 winning trades, the total reward of the 3 winning trades will outweigh the 1 losing trade. So if I trade options and I let option expire, the trade goes against me and lose 100% of the premium of the option, and 3 winning trades, I only capture, let's say 20% the winning, then even though I have more winning trades, overall I'm going to lose money. On the other hand, if I put 50% stop loss on a losing trade, but 3 winning trades are 30% each or 20% each, then I know every 4 trades over a long period of time, I will have more winning trades. So from my perspective, my application of the game theory to realize that ultimately when you face uncertainty, you don't know which way the market is going to go. You can assign certain probability of success. You know that if the market sold off in the beginning of August, and I'm showing this chart, right now market is trading in well-defined range, right? It's some kind of consolidation phase where bulls and bears are fighting for the position, but it's well-defined range somewhere around 2,800, 2,820 right now as a support, overhead resistance in 2,950. So you know, based on the probability of success, every time market moves 1 sigma, 2 sigma move, if you look at the trading range, then when you're in upper range and you just had 1 or 2 sigma move at the upside, then unless bulls have a case to break this overhead resistance, more often than not, the market will revert. So your odds that the market at 2,950, this is S&P future September contract, will revert back is higher. So then you go short at 2,950 with well-defined stop. How do you go short? You could put a debit put spread, right? If market has a false breakout and actually continues to go higher to 2,950, 2,970, and you know that it's not going to break 3,000 level, or at least you have a belief that it's not going to break 3,000 level, then you can close the short leg and leave the long leg, long put. So the idea is that even though at current overhead resistance, I can express both bullish and bearish bias by having a debit put spread. It's net short, but I have 2 legs at the same time that I can express short and long. So butterflies, condors, spreads, I think optimal strategy in a volatile environment, especially when you have a well-defined range. Once bulls are in control and we break out of the 3,000 range, then you need to change your strategy and have more of a trend trading. If the bears win and we break below 2,800 level, then you can take more of a bearish trend. But these are the strategies that can give you optimal results when you are faced with uncertainty. And often, as you know, if you're always a bull, that is not the most optimal strategy. If you're always a bear, that is probably not the most optimal strategy, because most of the time market actually go higher, majority of the time, over past 100 years. But we do know that we can go through a long period of volatility when the market can sell off 10, 20, 30, 40%. So being always a bull also not the most optimal strategy. Some of the highlights: identifying these key support and resistance levels to make sure we satisfy those 2 conditions to become a successful trader. One is probability of success. You know, what's your percentage of winning trade? And then the second thing is return on investment. So these are some of the highlights that I wanted to draw your attention. Let's go over the market. Today, I'm looking at the TradeSpoon stock forecast toolbox for 10 days. For 10 days, right now, market showing a bullish bias, even though we had FOMC meeting yesterday, not a lot of volatility, but now 11 o'clock Eastern Central on Thursday, we have Jackson Hole meeting, and there are new information coming out about potential interest rate cuts. Right now, there's the bias that we will not have as many rate cuts as everybody expected, so market is down. And last time I checked, we were as low as 29.04. So we've been trading in the range between 29.40 and 29.04. So right now, again, market reached the overhead resistance that we touched the entire August, and any negative news, the market retraced back 1% now, as low as 29.04. So it's very important for bulls to hold on to this 29.04, 28.77 level. If we break through that level, then potentially retest August lows. Long-term model shows that going now end of October, 50 days from now, this is a seasonal chart, takes a longer time outlook. It analyzes 25 years worth of data as opposed to just past few months, makes prediction on Sunday, and basically says going into end of October, beginning of November, I think the bulls will resume its uptrend and the sell-off, the current volatility will subside, and potentially if you have November, December outlook, then you can start building your long bullish positions. And again, this is currently market is trading 29.14 in the middle of the range of 29.30, 2900. Potentially, market will revert to its mean unless there is some positive news from the market. That's all I have for today. Hopefully you guys enjoyed my take on the game theory and what it takes to be, how to apply it to current market conditions. Send me your feedback, and I will see you next week. Thank you.